Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 15 minutes here on Options Guide TV. I mean, to sum up today's show is what Santa Claus rally, right? So as far as the consumer is concerned, going into the holidays, everything has been on the up and up, and the markets have held steady, even though there has been extra volatility in the marketplace. We have, the VIX index kind of creeping up a little bit. It's definitely not in the range of complacency, but we're down at this point in time. We're trading at 1345 on the VIX, according to the derived value. The actual value is up a little bit more. It's around 14 and a half. So we have a little bit of angst in the marketplace on this downturn of the market, but to so much for the Santa Claus rally, which is supposed to happen between Christmas and New Year. So this is the start of it. And we see gold got beat up over the weekend. Gold is now down 4.5%. The trade that we have on expires here on the 31st, and the trade got cut in half. So let's start by looking at the gold chart before we get into the trade. So good old the underlying that we use to trade in gold is GLD, and we had a solid breakout in gold, but we've came back right to the 20-day, and the 20-day can provide some support for the market. So with the downturn over the weekend, we're seeing us touch the 20-day moving average, hoping that that's a little bit of a range of support. But we've broken through this area right here, which is 397.43, which was the recent breakout. The high most recently was all the way back around 402, and that's what we were highlighting. We did one open wing butterfly that was centered right at 402. And allowed us to be profitable if it continued higher. It went higher. We put the trade on. Now, hopefully, we would have closed this on Friday in the short session. If you were trading it, we had that opportunity to get out. Time decay is happening. The markets will be closed this Thursday, but there'll be a full session on Friday. So we're only closed on actual New Year's Day, heading into the new year, and the trade will be dead on Friday. So you got Monday, you got Tuesday, Wednesday that you can trade it, and then you could also close it on Friday. Now, gold, the downside of gold is that it will continue to the trade. The price of gold is basically 24/7. You can trade gold. But the GLD you cannot, which is the ETF that tracks it. Now, with that said, we're sitting at $84. We put the trade on. We're about down half on this trade. If you didn't get out, which we should have been close to up a buck on that trade, just from where the market was at, and it was stalling and hanging out, but we put it on for $1.93. We see it now trading at 86 cents. I don't mind seeing if we get a little bit of a bounce here right off of the 20-day moving average, but we're down half on the position, and ideally we would get out of this trade if we put this on. So if you paid $1 and you're looking to make $1 on the trade, and we get down $1 on the trade, well, then we should just get out of the trade in general. So that's the way I would approach it. I might see where we land at the end of the day, give it a full day's worth of trading today before I look to close it. I do think that we do got a little bit of support here right on the 20-day moving average. But if we do get a solid breakdown but on the position, we could be down a little bit more and we could get out of the trade. Now, if you want to adjust this trade, we still got some premium left in it. So let's go back to the January 31st. We got a little bit of juice left. So The adjustment would be that we would come in and roll this into a short spread. Now, I'll show you this trade, but you're going to open yourself up to more risk. This is a strong downturn, about 5%. So obviously, if you go back, let's run back and look at the charts. You don't see a lot of, well, I guess we do. I guess if we go back here, we had a move that was pretty aggressive to the downside also, and we bounced off the 20-day, came back, and then that failed and just traded right along the 20-day moving average. Now we came down, we're right at that same location. As far as the 20-day is concerned, here we bounced, and here is where we're at, but we did obviously break through it. So if I'm looking at this, there's a way to flip the script and say we want to get bearish on this trade, and it is a hedge, but it adds more risk to your position. But this is, I don't want the cheese anymore, just let me out of the trap, is the way that I've always approached this with these butterflies. You sell the most expensive option contract that you own, and then you buy the least expensive, and you roll yourself into a short call spread. But you are setting yourself up. So at this point in time, we're down $1, right? We paid $2 for it. If you didn't get out last week, which I wasn't following it, honestly, and I think I mentioned that on the show that I'm traveling right now, so I'm not putting on a lot of weekly trades. But with that said, you need some juice in order to do this, and we're on Monday. Gold trades at it's a fairly expensive underlying, which creates premium, and we see that our 403 strike is still trading for $2. So if you wanted to try to capture a small gain, and you don't think, now realize on Thursday, that's New Year's Day, and that day you cannot trade. So if the market came all the way back to our 403, where are we at here? Down here. Okay. 408 is where our short options are at. So 408 is right here. That's where our danger zone would be, from 408 on up. So so that can obviously make this type of move in the short term, and there will not be much that you can do. You're just going to close out the position. If I ever make an adjustment on a butterfly, I make one adjustment and then I just move on. So here's the adjustment. Let's get back to here. Sell the 403, buy the 410. So in this instance, you got the 403 trading for $2.33. We're going to capture that. We're long this option contract. If we buy the 410, we got a 2-point wide spread. We're going to be short 2 of the 408s, and that's where our risk is. And we're going to be long 2 of the 410s. That means that you have $200, right, from 408 to 410, but you did 2 of them. So you're going to get this done 2 times, and you'd have $400 worth of risk, and our overall position would be break even or a little bit of a net credit to the account. It's going to be a small gain. So let's look at this. Remember, we paid $193 for it, so our credit needs to be more than $193 to offset the initial cost. So in this scenario, we'll keep that one here. We're going to sell this option contract. This would be to close, but I can't do that because the position's not on in this fake account. So we're selling that to close, and then we would be buying another one of the 410s, and this position would go away. Sell to close, buy to open, still have 2 short 408 calls. Sell to close, buy to open, still have 2 short 408 calls. So in this instance, we're bringing in a net credit of 155, which the market, it seems like it just moved on us a little bit. So if you did this, you're locking in a loss of 193. We'll call it 190 minus 155. So that's 35 cents. We'd be bringing in a net credit of 150. We paid 193. If we just closed the position, we would be out at 86 cents. So this is an adjustment. I'm not saying that you should do the adjustment, but I want to show you what an adjustment would look like. And if we could have adjusted, I guess we just need a couple more days, right? And that we either need the market to bounce back to make this so that we can get out at close to break even and still have the risk, though, until Friday. But this is a viable adjustment in some cases. I don't really like it right here because we're not at least getting 193 net credit. And if I'm looking to do these adjustments, that would be my trigger, right? When this spread is trading for, I'll say $2, because that's what we basically paid. So when this is trading for $2, that's when I would do the spread. So this morning when the market was going down, there was maybe an opportunity to do that. And then you go from being bullish on the market to being neutral to bearish. It's not a bad alternative. So then your final position would be, but once again, I want to get 190 for this, but this is just a learning session here. So 143 is the net credit right now, which has actually even moved more to the downside. Now we're down 18. But I would take this position, you're short 2 of the 408s, and let me just put what final position we'd have on. So this would go away because this would be a sell to close. We would add one of these. We'd end up with 2 of these, and we'd be short 2 of these. And I'll send that to the what if calculator. So that's a net credit of 28 cents just if you were to do it today. 2 points wide, 28 cents. It's a medium trade if you were to put it all on today. But by rolling it, we bring in a bigger net credit because remember, we're selling the expensive one, buying the cheap one. But this is where our risk would be right here. You have risk from 408 up to 410. Above and beyond, your risk is limited and known. But if we do start going towards the 408 level, your only alternative then is to just close the position, period. So I would look to close. If this was trading for $1, I'd be like, okay, I brought in $1.55. I'm now losing $1 on my short spread. And now I want to get out of that position. And $1 would actually only mean if I put this on, and remember I have 2 of them on now too. So on this position, I'm short 2 short spreads from 408 to 410. The margin requirement on one spread is $2 or $200 per 1-by-1 spread. And we did 2 of them. So the margin risk is now $400 total. Okay. Hopefully got out of the position. The chart is, we're even down a little bit more now. So we've officially broken below the 20-day moving average. A little bit at this point in time. So, well, bottom line is it doesn't look good for gold at this in the short term over the next week. So I would look to close the trade today if I was still in it, or that roll I don't really like, but keep that in your back pocket. That is a trade that is very viable to do if you can get it done for at least the net credit or net debit that you paid for the butterfly. All right, I don't have much more than that today. The Santa Claus rally is here. Well, at least it's the market's not rallying, but this is supposed to be that time of year. And I was hoping that we could lean into a bullish market and look at doing a short-term SPX trade that would expire on Wednesday. We'd probably go a couple of days, head into the holidays. Don't want to leave the market. I wouldn't want to go all the way till Friday, but in the SPX, you have that benefit. But I'm seeing just nothing but negativity. And I don't really want to lean into the negativity of the marketplace. But, you're seeing a lot of retailers, Amazon, even Walmart is down today. I'm pretty sure it is. Right? Oh, up 61 cents. Okay, pretty much flat. Let's see where Target's at. Target's down 82 cents. Costco, another high flyer, down 375. So interesting to see a little bit of strength in Walmart today. I wouldn't call that a lot of strength, up 0.5%, but in a down market, that looks that's fairly good news for Walmart. CME is down, Google is down, Home Depot is down. Yeah, there's a lot of negativity going on right now. So if I were to do something, I would probably just do a one-day trade. But now the market's a little bit late. 11:19 right now, Eastern time. If we're doing one-day trades, I'd like to get them on by right at the top of the show, 11 o'clock. But 10:30 is ideal for me, between 10 and 10:30, to do a one-day trade. And we're supposed to be back on Wednesday. We've got a full trading day. Well, let's look at one. Let's look at a bearish trade. Let's lean into the bearishness. And we'll take a real quick peek, just so that we got something to talk about on Wednesday. Oh, by the way, our 2-day trade, I taped a show, and I don't know if you watched it. If not, go back and review it. We went over a great review of the gold trade and of the SPX trade, but the SPX trade paid out very handedly. It was only a 2-day trade in the market. The bullishness was there last week. Now we're looking at 29th would be today. So the 30th would be the day that we'd be looking to get out of the trade if we did this to the bear side of things. 10 points wide. All right, I'm going to put it on. I'll put it on. I'm not suggesting this trade, but I want to have something to talk about on Wednesday. So let's lean into the bearishness. The market at 69.27. So 20 right in the middle of the two, of course, which is annoying. I want to sell the at the money. So that would be just in the money. Yeah. Let's go. Let's try this one. See how expensive this is. And we're going to hit the bid twice. Right now, 69.27 in the SPX, and I'm showing over here. Market's down a little bit more than that. Yeah, I don't. The derived value right here isn't following the markets as well as it should. So I'm seeing the market right now at 68.98, so 6,900. Yeah, that's more like it. I don't know why this number is off right now. Let's do it that way. Let's sell the 6,900. I like that. I like that trade a lot better anyways. December 30th is the expiration. 6,900. We're going to buy this one, sell 2 of the 6,900s, and stop short and buy one of these. Yeah, I don't mind that. 310. That's not too ridiculously expensive. Now, this number is off, and you can easily tell that by looking at the 6,900 to call is trading almost what the put is trading for. So in this instance, we're buying the 69.10, selling two of the 6900s, buying one of the 68.95s, $3.10. Let's call it $3. That'll be the paper trade. We'll look at this for the day. If I put this trade on, we have a half a day today, and then we have all day tomorrow. Markets are going to be closed on Thursday, but this trade is cash settled. It would be done by Thursday. We're looking at 10-point wide spread. The maximum that it could trade for would be $10 minus 7, which would be $3. Or I'm sorry, $7. I'm said that wrong. 10 minus 3, which would be $7. That's going to be our upside. And let me zoom in here. And we're just going to put this trade on just to watch it. Okay, we'll watch it for today. If I put the trade, if I got out of the trade, you're looking to get out at around 2 o'clock. Remember that if you make a couple of dollars on these trades, just because of time decay, we want to look to get out. The market is right at 6,900 at this point in time. That's still trading right close to there. And if we go down, we paid $3 for it. It's got to be trading for $5. And so we would be up to $200 on every 1x2x1 butterfly, or $2 on the trade. It's not a horrible trade. Though the downside is that we got to open up tomorrow. So I think we lean into the bearishness tonight. If we get the markets to come down below our lowest strike, there's not too much to worry about, because then the market can come back and we can get out here. So if we're trading somewhere in this range, we can feel safe to see if we can get some time decay to try to get a little bit more of a boost on the upside. Yeah, this isn't a horrible trade considering the bearishness of the marketplace as a whole. I would rather it be a 0 DTE trade, meaning that it would end at the end of the day today. But I think we're going to leave it there. Not bad. Not too bad. The gold trade was good if we got out heading into it. Oh, all right. I let my gold trade expired. It worked out well. Okay. Thanks, Kurt. When the gold trade that I had, oh, it expired on the 26th. So did you do a shorter trade? Let me run. If I look at my notes, we had the 31st on it. Kurt, kind of wondering. The SPX trade expired last week, but I had the 31st on gold as the expiration. Oh, yeah, we did the one from a little bit ago. Yep, that did. That trade worked out really well. This was the trade that we recently did. Yeah, is the 31st. And and there was many opportunities to get out at a decent profit heading into the weekend. And I always realize if you get that opportunity, staying in a metals trade that trades 24/7. So like if you can get out on a Friday and you have that profit, or you're doing fairly good, taking the risk over the weekend is usually not worth it in something like a gold position. It's not as nerve-wracking in S&P 500 index, which is 500 different stocks. But when you're talking about an individual metal, dollars, anything like that will trade all weekend long, then you obviously can't get out of those positions. All right, that's it. No other question. Go ahead and put Kurt's last comment. Went beyond the tent. So I let it go to expiry. Okay, that sounds great. Thanks, everybody. Have a happy new year, and we will see you at the beginning of the new year. We will do a show on Wednesday. I'll probably just look at this SPX trade. That will already have expired, but I'll keep an eye on it over the next couple of days. But like I said, I'm not doing a lot of these trades. And when we get back into the new year, I think we'll go in and look at a few of the longer term positions that we put on, and we'll start out the new year by just kind of reviewing some of those trades and think about what type of trades we might want to get long and how to get long heading into the new year. Thanks for stopping in, and we'll see you. I guess we'll see you on Wednesday. So we'll see you before the new year. Take care.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.